Just saying these words gets tears in my eyes.
Paytm launched its initial public offering in November 2021 when the Nifty was at its all-time high. It was the country's largest IPO with a valuation of $20 billion. If we put that into perspective, Nykaa has launched its IPO at a valuation of $7.4 billion, which translates to 55,300 crore rupees, and Nykaa got listed at a premium of 79%, giving the company a valuation of $12.86 billion. Now, despite being the most hyped IPO with such a premium valuation, why is Paytm's share price falling? To answer this question, we must understand a few pricing fundamentals. For example, if we compare Paytm's valuation to that of India's largest fintech platform, PhonePe, it has a valuation of only $5.5 billion, which is roughly 41,000 crore rupees. Now, Paytm's price band of 2,080 rupees to 2,150 per share during the IPO was also a major source of concern for investors across the country, considering that it was valued higher than the industry leader. And that concern was further evident when the share price was listed at Rs 1,955 with a 9% discount. Following that, there was an immediate sell-off with the stock price hitting a 20% lower circuit on the same day. Paytm has lost a third of its market capitalization on its first day of trading. Ironically, India's largest IPO saw the largest fall on listing day in the country's IPO history. But before the IPO, things were completely different. The hype around Paytm was unbelievable. Now, fixing the price band of the IPO is very important. It should not be overpriced or underpriced, as either can lead to a loss for the company. When asked about the pricing of the Paytm IPO, the company CFO, Mr. Madhur Deora, said something different, which struck to my mind.
Do you think the team perhaps got the pricing of the offer a bit wrong?
The team doesn't price the IPO, the investors price the IPO. So investors who have backed Paytm, the issue size, of course, as you know, is 18,300 crores, $2.4 billion, one of the largest IPOs in Asia this year, obviously the largest IPO in India ever. Those are the investors that price the IPO, right? So I think the question whether pricing was wrong and all of that is a strange question, because investors price the IPO is just a fact.
However, this was not an entirely true statement. You see, the price band and the minimum bid lot of an initial public offering is decided by the promoters or selling shareholders of a company in consultation with the book running lead managers or BRLMs. So, in addition to investors, promoters and investment bankers do have a stake in determining the price band. But to claim such a high valuation, is Paytm really making any profit? A simple answer to this question is absolutely no. But you may wonder why. The company's revenue is the foremost reason for this. Now, if we look at the company's financial statements, we can see that the sales has been stagnant for the past 3 years. Even if we look at the quarterly numbers, Paytm declared the worst result in the December quarter of 2021 with a net loss of 778 crore compared to the previous 4 quarters. But in order to fully understand this poor performance, we must first understand how Paytm makes money. Paytm generates its revenue from 2 revenue lines. Payment and financial services account for 75% of this revenue, with commerce and cloud services accounting for the remaining 25%. Under the payment and financial services, Paytm provides payment services to the merchants and charges a fee based on the gross merchandise value, or GMV. GMV refers to the volume of goods sold on its platform. Paytm has also partnered with financial institutions to provide financial services from which they generate revenue based on the services provided, such as loans, insurance, and wealth management. They also generate incentives, sourcing fee, distribution fee from distribution of loans and credit card. Like for example, when a loan is disbursed, Paytm collects a sourcing fee from the lending partner. Apart from this, they earn money from credit card business, where similar charges are taken from the partners, along with services like stockbroking, mutual funds, etc. The second segment is Paytm's commerce and cloud services, where it earns 25% revenue. Here, Paytm makes money by charging merchants a transaction fee and charging consumers a convenience fee, which is typically a percentage of transaction value for travel, entertainment, ticketing, and other commerce services. For example, when you book a flight ticket, Paytm charges the airline a transaction fee and a convenience fee from you as well. Paytm also provides software and cloud services, where they charge its merchants a subscription fee and in some cases a fee linked to the volume of activity on Paytm's platforms. Paytm also runs performance and brand marketing campaigns for merchants by charging them based on the size and type of campaign. Paytm uses target advertising in this case since it has a monthly user base of 150 million active users. For example, if you open the Paytm app and navigate to the Paytm Mall segment, you will notice a large advertisement on top. They also display advertisements after you complete a transaction via push notification and even with coupons. But despite having such a diversified business, it is important that we answer the real question. Why is the Paytm share price falling? In order to understand this further, we'll need to go back to the final day of IPO and see the response received for Paytm's and Nykaa's IPO. On the final bidding day of Paytm shares, the IPO was subscribed 1.89 times, where Nykaa was subscribed 81.78 times. Institutional investors subscribed 2.79 times for Paytm against 91.18 times for Nykaa. Non-institutional investors subscribed 0.24 times for Paytm compared to 112.02 times for Nykaa. Retail investors subscribed 1.66 times for Paytm while it was 12.24 times for Nykaa. Paytm's grey market pricing of the IPO was also at a steep discount due to the company's higher valuation. In fact, many institutions had downgraded the stock at that time as well. Like for example, A.K. Prabhakar, head of research IDBI Capital, said that Paytm is not a secular growth story. One has to wait for a very long time for them to make profit as big people are entering the field. Also, it is expensively priced. Another financial research firm, Macquarie Capital, published a research report on Paytm's listing day. It titled Too Many Fingers in Too Many Pies, in which they stated Paytm's business model lacks focus and direction. The company was termed as a cash guzzler in the report, and its scale and profitability were questioned. The report went on to further add that Paytm has been a cash-burning machine spinning off several business lines with no visibility on achieving profitability. Paytm has drawn in equity capital of rupees 190 billion since inception, of which 70%, around rupees 132 billion, has gone towards funding losses. The business generates very low revenue for every dollar invested or spent towards marketing. This is especially problematic for a low-margin consumer-facing business where competition across each vertical is only increasing. These mixed responses from management as well as equity research analysts spooked investors, giving it a huge momentum for sell-offs. After all, stock market doesn't like uncertainty. Talking about uncertainty, that would take us to the next question. Will Paytm ever be profitable? In order to identify this, we will need to see where Paytm stands in terms of its financial performance as per the recent quarterly results. Paytm declared consolidated net loss of Rs 778 crore for the third quarter ending 31st December 2021. Around the same time last year, the company had reported a net loss of Rs 535 crore and Rs 472.90 crore a quarter before. This means that this year, the company had lost more money than previous year. However, if we look at the revenue from operations of the company, it increased 89% to Rs 1,456 crore for the December quarter. This growth came from segments such as merchant payments through MDR paying instruments, new device subscriptions, and loan disbursements. Now, if you have a doubt about what MDR bearing instruments are, they are simply Paytm Wallet, net banking, debit and credit cards. But despite losing money, Paytm is still sitting on a huge pile of cash to spend. In fact, the management said that it is well funded with the investable cash balance of Rs 10,215 crore as of December 2021. Another positive thing for the company during this quarter was how the gross merchandise value grew by 123% year-on-year at Rs 2.5 lakh crore. But this was mainly due to the impact of festive seasons. During this quarter, Paytm was also able to increase its revenue from payment services of consumers by 60% and its revenue from financial services by 201% and loan disbursement by 366%. But when the revenue increased, so did the expenses. On the expense side, Paytm's marketing and promotional expenses rose to Rs 283 crore as against Rs 211 crore compared to last year. Also, the company's total expenses increased by 72% to Rs 2,317 crore during the reporting period as well. Now, what has been happening to Paytm reminds me of a great company called Yahoo, which was doing quite well until competition kicked in. When companies like Google started to gain traction, Yahoo began to diversify in search of new revenue streams. They had nearly 400 divisions including Yahoo Games, Yahoo Directory, and Yahoo Finance, among many others. This not only caused misunderstanding about the company's actual vision, but also resulted in infighting, unhealthy internal competition and disagreements within the management. Now you may ask, what makes it similar to Paytm? Well, if you look at Paytm, it's trying to compete with everyone. There is an e-commerce section, a stockbroking division, movie tickets, insurance segment, and many more. If you look at these segments, Paytm is competing with already established players like Amazon India, Book My Show, Policy Bazaar, Zerodha. This does not mean that Paytm will fail in these segments. However, the competitors are cash rich and has a core focus on their specific business models. But does that mean Paytm is destined to be doomed, or is there a possibility to become profitable? Paytm's journey to profitability is still achievable. Firstly, there is a potential approval of a small finance bank license for the company. This means that the company can get into lending business without partnering with the banks and NBFCs. Currently, Paytm has a payment bank license within the group where Paytm owns 49%. However, the payment bank license has restrictions around lending as well as deposit caps. As a result of this limitation, Paytm is unable to lend from its own balance sheet. However, according to RBI's lending policies, Paytm will be eligible to apply for a small finance bank license next year after completing 5 years of payment banking operations. However, we will need to see whether the RBI grants Paytm a small finance bank license. If it does, this would make a huge difference for the company. The next potential opportunity is how Indian government is planning to levy charges on UPI transaction. If this happens, Paytm will earn a significant amount of revenue from this segment, given that India may reach Rs 1 trillion in UPI transaction per year in the next 3 years. If Paytm is able to further capitalize on growing digitization, and if it can grow at a CAGR of 40% over the next 5 years, it is likely to achieve profitability. However, the competition in fintech business is cutthroat, and new age startup can access huge amount of funding, which can lead to further cash burning in the pursuit of customer acquisition and resulting more competition for Paytm. Paytm will also need to make sure that they match the level of services which they offer in each of its segments, since the already established players can do this more efficiently. As an investor, we will need to keep an eye on Paytm's quarterly results as well as the transparency of management getting improved in the future. If you like this video, then drop a like and do let us know what are your thoughts in the comment section. Also, don't forget to subscribe to the channel for more stories which nobody else covers. Just like the story of Paytm, if you would like to watch the story of HDFC Bank and the problems it's facing, you can click here to check it out now. See you guys on the next one. Bye bye.